I have a hedge fund. What do I charge people? Right? I get it all the time. What do I charge people? What do I charge? Well, traditional hedge funds, okay? Traditional hedge funds would charge 1 to 2% as a management fee, and then 20% as what's called an incentive allocation. Okay, let's talk about the management fee. Management fee is a fee that's intended to cover the manager, the fund manager's overhead. So like salaries, rent, whatever, overhead. And typically in a traditional context, 1 to 2% is that monthly fee. And how it works is one of two ways. It's calculated and paid in advance of the month, right? Or it's paid 1 month in arrears, meaning it's 1%. So if you had $100,000 assets under management, you take 1/12 of 1% times 100,000, and that would either be paid at the front end of the month or 1 month in arrears at the beginning of that month, right? And again, it's meant to cover overhead. It's not meant to be sort of a profit center. So 1 to 2% has always been the norm. Now, startup hedge funds are well advised to keep that lower, okay, in the sense that it presents a barrier to entry to somebody who wants to invest in your fund. Okay, so you don't want to come at people with, a 3-4% because it doesn't necessarily give them a reason to invest or get into your fund, especially in the early stages. Now, the incentive allocation is a little bit different because it's performance-based, right? Okay, and so typically it's 20% of the profit that fund earns, and that's pretty standard. Now, in the crypto space, because of one, liquidity issues, two, because it's a very nuanced and sort of specific area, right? I've seen a lot of funds do well charging 35%, right? And that's high, but given the alternatives, it's really your only chance for exposure, right? So you can justify it in certain contexts, but as an investor, I would look to see what that fund is actually doing, right? I mean, what are they doing? Are they just pimping ICOs, or are they, do they have some algorithmic or quantitative trading strategy that has a proven track record, and you could substantiate, parting with 35% of the profit that you otherwise would be entitled to as a limited partner in a hedge fund? Okay, so from, my vantage point as one who sets up hedge funds, okay, I think you start, initially, especially when you consider the limitations of a startup hedge fund, right? The 3C1 exemption of the Investment Company Act limits you to 100 accredited investors. So you're only going to get to a certain level, and you can only take that incentive allocation from accredited investors, so they have to be accredited. Well, I would be wary of taking fees that sort of vary from the norm, right? An accredited investor may have exposure to traditional product hedge funds and may be accustomed to 2 and 20%. I wouldn't veer drastically from that, mainly because you're competing with the ecosphere of hedge funds, of financial products, whether it's debt, equity, swaps, options, you name it. And you're also competing with the varied strategies, high frequency, long, short, whatever the case may be. So you have to consider that, right, when you're starting a fund, and when you're investing in a fund, you also have to consider that. So my I guess my message is sort of coming from not only perspective of an attorney who's advising you on how to maybe set up a fund, but also as an investor, or maybe you're a fund of funds, right? And then this is sort of relevant on both ends. But generally speaking, I'd like to keep the management fees low and the incentive allocation higher, right? Especially because the performance-based aspect of it inures to more investor confidence, and presents a lower barrier to entry. So, the question is, what do I charge people? Well, you can charge them whatever you want, in theory, right? As long as it's properly disclosed in your offering memorandum and it's properly accounted for, in theory, you could charge whatever you want. But again, you're marketing, right? This goes back down to marketing, and there's limited funds out there, and people want exposure to crypto, so maybe they're willing to pay a little bit more on that incentive allocation. But I keep the management fees low. That's my advice. I would say don't veer from the norm and go to 3-4% just because you have an illiquid asset, right, in crypto. I don't think that, or you have higher transaction fees versus equity. I don't think that makes sense. I think what you have to do is overcome the barriers to entry, which is that fee, right? And I'm an investor saying, well, I'm going to put in $100,000, but 4% of it goes out the door right away in the first year, right? Just to pay your salary. I think that the optics are poor. So I think keep that more in line with what traditional funds are, to try to bring money into your fund, and then increase it maybe on the incentive allocation side because you have specialized knowledge. If you are in fact running like a sophisticated high frequency quantitative trading hedge fund that's based on cryptocurrency, then you have a skill that very few people do, in fact have. So the answer to the question in like a very, very brief answer is really whatever you want to charge, but I'd be very cautious and concerned about the optics of it and your ability to raise investor funds given that management fee especially. So hit me up. I'm on everything, I guess, but how about Telegram at Adam_Tracy, Tracy, no E. Follow me, let's chat. I got a good room going there to talk about legal issues of the day. Happy to answer people's questions on there. So hit me up. Talk to you later.